So Nicole, we're getting a lot of the same questions from clients as they're now starting to think about and work through their DISE implementation.
Yeah, what are some of the things you're hearing?
So some things I'm hearing over and over again are like, hey, our cost of goods sold has inventory purchases, labor, depreciation, and overhead. How do we split that up? Other things that are coming up are like, hey, we're using contractors. We also have our own employees. How do we distinguish that for the disclosure? And then even around like software capitalization cost, there's questions around like, hey, does that go into depreciation? Does it go into intangible amortization?
Yeah, those are questions that come up once you actually move from theory to practice. You understand the concept, but application gets complicated pretty fast.
Mm-hmm. And that's exactly what we're going to tackle today, right? We're going to get real specific on kind of what goes into each of those 5 natural expense categories that we talked about over and over again on episode 1, and really talk about how you kind of work through some of these tricky areas that do come up in implementation. So welcome back to Accounting Matters. I'm Adam Olsen, Embark's National Head of Practices.
And I'm Nicole Harger. This is episode 2 of our 3-part series on DISE, disaggregation of income statement expenses. If you haven't listened to episode 1 yet, go back and start there. We've covered the why behind the standard, who it applies to, and what makes an expense caption relevant.
Yeah, and today we're going to dive in deeper to those 5 required natural expense categories. Running through that list again like we did on episode 1. So purchases of inventory, employee compensation, depreciation, intangible asset amortization, and DD&A. We'll cover what's included in each of those categories. It may not be as simple as you think. And also what's not included. And we'll tackle some of those tricky technical areas that do come up when you think through the standard.
Yeah, and so fair warning, this is going to get into kind of the technical details today. This is really where rubber meets the road on implementation. So grab your coffee, pull up the ASC, let's get granular.
Well, let's do it. All right. So before we dive into those 5 specific categories, I do think we need to establish a foundational concept here. So kind of what is the difference between a natural and functional expense classification?
Great question.
And why this matters, because it's really at the heart of what DISE is trying to accomplish when we step back and think about the standard as a whole. So functional expenses, and we need to define this carefully, is going to be categorized based on the purpose for which the expenses are incurred. So these types of expenses really describe where or why you spent the money, right? So think about your typical income statement line items: cost of sales, selling, general and administrative expenses, research and development. Those are all functional categories. They tell you what the business activity of the cost relates to, and they tell you the function, or they tell you kind of the department.
And so your natural expenses, on the other hand, are categorized based on the types of economic benefits obtained from the expenditure. They describe the type of the cost incurred without consideration of the department or function for which it was incurred for. So natural expenses include things like purchases of inventory, employee compensation, depreciation, amortization, supplies, utilities, rent, professional services. The standard defines natural expense classification as a method of grouping expenses according to the type of economic benefits received in incurring those expenses.
All right, so let's start with an example here, maybe to solidify this. So let's say you've got $100,000 in salary costs for production workers. Let's walk through kind of both lenses here, okay? So from a functional perspective, the $100,000 goes into cost of goods sold. Why? Because it's manufacturing function. It's where the cost was incurred, and it relates to kind of that production process of the inventory. From a natural perspective, it's employee compensation. Why? Because that's the type of cost, right? You're paying for the labor of those people. It's about what you're buying, which are the labor and services from those individuals. So under DISE, if we try to bring this all together here, right, you've disaggregated that cost of goods line item to show the $100,000 as employee compensation. And the key concept emphasized here is it's the same dollar of expense. It just gets looked at through 2 different lenses, both the functional lens for the income statement presentation, but also that natural lens, which is what the DISE disclosure is trying to get at.
Yeah, and so here's why this matters from an investor perspective. if I'm analyzing two manufacturers and both show $10 million in cost of goods sold, I don't know if one is highly automated with lots of depreciation and less labor, while the other is labor intensive with less capital investment. So that difference matters for understanding cost structure, operating leverage, sensitivity to different economic pressures. The natural expense disclosure gives investors that visibility. Many income statements are presented using functional categorization, which means there could be an extensive list of natural expenses within each relevant expense caption. So to balance the costs and benefits, the FASB limited the required natural expense categories to 5, allowing for standardized, comparable disclosures.
All right, so let's dig into the first category of those 5 natural expense categories, purchases of inventory, which is probably the most misunderstood, I think, based on some of the client questions that we're hearing about. So let's really break this down. So purchases of inventory include only amounts that are related to externally purchased raw materials or other tangible items that would be within the scope of the inventory standard. So ASC 330, or any other industry-specific inventory subtopics that may be out there. The keywords here, though, are externally purchased and tangible items. So this is really about what you're buying from third parties, so raw materials, supplies, work in progress, finished goods. It's external spend on those tangible items. And this is narrower than you might think because it does not include all of the inventoriable costs under ASC 330. So under ASC 330, if we think about inventorial costs, those also include kind of all the costs related that are directly related or indirectly related expenditures to bring that inventory to its existing condition and location. So under that definition, that would also include like acquisition costs, production costs, like labor, overhead, depreciation on equipment, etc. But for DISE purposes, only that external purchases of the tangible items themselves go into that inventory purchases category. So the labor gets disaggregated then into other categories, right? So employee compensation and the depreciation into depreciation, etc. So again, it's really just about the acquisition cost of the tangible items and not all those other costs that go into inventory.
Yep. So it's a subset of inventoriable costs. Now, there are also specific exclusions companies need to understand. Purchases of inventory excludes amounts recognized from certain non-recurring transactions, specifically business combinations, joint venture formations, and initial consolidation of a VIE that is not a business combination. So if you acquire a company and they have $50 million of inventory on their books, when that inventory flows through cost of goods sold, that $50 million does not go into purchases of inventory. It would go into your other items or can be voluntarily disclosed separately. But here's kind of an important nuance. If you acquire inventory through an asset acquisition that is not a business combination, or if you acquire a voting interest entity that doesn't meet the definition of a business, those do count as inventory. So it's specifically the business combination, joint venture formation, and BIE consolidation scenarios that are excluded.
Got to get that definition of a business correct then, right?
Yep.
All right, let's talk about intercompany transactions a bit because this is relevant, I think, for a lot of companies that obviously have multiple entities and manufacturing sites and things like that. So purchases of inventory is intended, like I said, to only capture those externally purchased inventory items, right, that we talked about. And that's from the standpoint of the reporting entity. So in consolidation, intercompany transactions would get eliminated. You're only going to include those purchases from third parties outside of the consolidated group. However, when operations are vertically integrated, what constitutes purchases for the group versus for each subsidiary can be very different. So if you've got subsidiary A and they buy raw materials for $50, manufacture that into some type of work in progress, and then they sell that to a subsidiary B for $170, that $170 is a purchase from B's perspective. But in consolidation, obviously, you would eliminate that intercompany transaction and only show that true original $50 external purchase.
Yeah, so companies need systems that can easily trace back through their intercompany transactions. Now, a question that keeps coming up, what about costs to acquire inventory beyond the invoice price? So think about your inbound freight, tariffs, customs duties, taxes, do those go into purchases of inventory?
Yeah, and I think this is one area where we're hearing about diversity in practice as different companies are starting to think through this. So I think some entities are taking a broad view and including all direct external acquisition costs. So the price paid, net of rebates, discounts, plus tariffs, taxes, inbound shipping, et cetera. And then there's others who are taking a more narrow view and only including the invoice price with other acquisition costs kind of lumped into more that other items portion of the disclosures. So we believe either approach could be acceptable here. I think as long as it's disclosed if it's material, and then obviously you need to consistently apply that approach.
So we do think most companies will elect the cost incurred method because the expense incurred is going to require tracking the original nature of costs or inventory over time, which is challenging with LIFO, average costs, or retail inventory methods. So the FASB acknowledged this might be operationally impractical, particularly if you are liquidating aged LIFO layers.
Yeah, no fun there. And like I said, I think that's why there's optionality here, right? So cost incurred or expense incurred. One of those implementation considerations companies are going to have to think through when they decide which method to adopt.
Yep.
All right, let's move on to the second natural expense category then, which is employee compensation. And I think there's a lot of nuance here that we're hearing, with some of those questions that were coming up at the beginning when we kicked off. Because there is a specific definition of employee and compensation that companies are going to have to follow. So starting with who counts as an employee. So the definition here does align with other definitions of employee, which are included in ASC 718. And so an employee is an individual over whom the reporting entity exercises or has the right to exercise sufficient control to establish an employee-employer relationship under common law. That's the definition that's used in GAAP. So this can include both full-time employees, right? Obviously, they're part-time employees. It can also, though, include temporary or seasonal employees. But I think the key thing here is that there must be that employer-employee relationship under common law.
Yeah, and it's important because not everyone your company pays for services meets this definition. So contractors, subcontractors, consultants, those are not employees. So compensation to those individuals doesn't go in the employee compensation category. It's going to go into the other items, or it can be voluntarily disclosed separately. There's also specific guidance around leased employees. So an individual leased from another entity can be deemed an employee of the lessee if certain criteria are met. The leased individual qualifies as a common law employee of the lessee, and the lessor and the lessee agree in writing to 5 specific conditions, like the lessee having the right to hire, fire, and control activities.
Yes. So companies that are using professional employer organizations or staffing agencies, I think really candidly just need to look at their specific arrangements to really understand kind of those facts and circumstances. So now let's talk about what counts as compensation. So I think the definition broadly here captures major types of consideration that are granted to employees in exchange for those services. So this includes all forms of cash compensation that typically come up. So right, your normal wages, salaries, bonuses, if there's any profit sharing arrangements. But it also includes share-based payment arrangements. So any stock options or RSUs or any kind of employee stock purchase plans, those things would also be included as part of the compensation equation. And then in addition to that, it also includes the benefits of the employees, right? So any medical, pension, post-retirement, non-retirement, post-employment benefits, all of those things are included. And then lastly, it includes kind of the compulsory payments, payroll taxes, Social Security contributions, unemployment insurance, workers' comp, et cetera.
So for defined benefit pension plans, employee compensation includes only the service cost component of net periodic pension cost. The other components get reported separately in the tabular disclosure. One-time employee termination benefits, so benefits for employees who are involuntarily terminated, are reported separately as exit or disposal costs under ASC 420, not included in the regular employee compensation category. And there's an election around other transactions for employee benefit, so subsidized meals, gym memberships, other perks. You can elect to include those in employee compensation, but you're not required to. So if you do, you must disclose it and apply it consistently.
Yeah, if material. Here's a practical challenge. So distinguishing between employee and non-employee costs when they're mixed in your systems, right? So if you have part employees and part contractors, the standard does allow for estimates. We should probably highlight that, like throughout the standard, there's estimates that are permitted to be used. So you could calculate the percentage of your workforce that's employee versus contractors and apply that to compensation components common to both groups. But one thing to be careful with components unique to employees like pension costs or payroll taxes, those should be fully attributed to the employees, right? Because that's all they relate to. And your estimate also needs to be reasonable if you're going to use estimates. So if contractor rates differ significantly from employee rates or contractors are concentrated in certain functions, a simple headcount percentage might not be the best estimate. You might have to come up with something that's a bit more robust.
Yeah, and it's also important to note that a lot of the information that's needed for this, so who qualifies as an employee, departments, compensation types, all that fun stuff, that information often lives in HR and payroll systems and not accounting systems. So companies may need system integration, data feeds, controls, whatever it is, that's needed to get the information into the financial reporting process. And this can be especially challenging for companies across multiple jurisdictions where employment laws differ and systems are not consistent.
All right, so let's move on to the next natural expense category, depreciation. So for depreciation, amounts should be consistent with what you're disclosing for total depreciation expense under ASC 360. Pretty straightforward, right? So This is depreciation of your long-lived tangible assets, so your buildings, your machinery, your equipment, furniture, fixtures, whatever.
So what about finance lease ROU assets and leasehold improvements?
Good question. So ASC 842 actually doesn't specify whether those are tangible or intangible. So under DISE, you could include the amortization, either depreciation or intangible asset amortization. So I think, you need to more or less kind of follow what you're doing today in practice and follow that consistently. I think most entities include finance lease ROU assets in, fixed assets. So the amortization would go in depreciation. Also, asset retirement obligation depreciation goes in depreciation because the capitalized ARO costs are part of the total cost of that long-lived asset, just as a little nuance.
Yep. And then for intangible asset amortization, amounts should be consistent with ASC 350. This includes amortization of assets in scope of ASC 350-30, software to be sold, leased, or marketed, intangible assets acquired individually or in groups, cost of internally developing identifiable intangible assets, so customer relationships, your trade names, your patents, acquired technology, etc.
Yeah, I think it's important too to also highlight there's sometimes things that are called amortization that are not in the scope of ASC 350. So those types of things, obviously, you'd want to exclude from this kind of disclosure. So this includes things of like amortization of any like deferred contract costs you might have under ASC 340, film costs under industry guidance there in ASC 926, debt issuance costs, right? I think we refer to like amortizing debt issuance costs under ASC 470. That wouldn't qualify. License agreements under other industry guidance. So just wanted to highlight that there's sometimes things that are characterized as amortization here that wouldn't necessarily qualify for this part of the disclosure.
Yep. And then what about internal use software under ASC 350-40?
Yeah, so I think this is another area where there is diversity in practice because ASC 350-40 references ASC 360 disclosure requirements rather than ASC 350-30 disclosure requirements. So some companies classify it as fixed assets and include amortization in depreciation. Others classify it as intangible assets and include it in amortization. So again, this is another area where there just is diversity, and the FASB didn't resolve this diversity when it came to DISE. So I think look at your existing policies here. whatever that is, make sure that you're following that consistently and, provide disclosure around that just so it's transparent on how you're treating those.
Okay. And then lastly, DD&A, which rounds out our 5 fund categories. This is for extractive industries. It includes depreciation, depletion, and amortization of capitalized costs for oil and gas producing activities under ASC 932-360, plus other depletion expenses like mining under ASC 930. Companies can combine DD&A and other depletion or break them out separately.
All right, now that we got through the 5 natural expense categories, let's just hit real quickly on just some special considerations that kind of exist within the standard. So there are some special situations that it addresses. So these relate to asset-related expenses, certain asset-related expenses, I should say, liability-related expenses, and then expense reimbursements and how we kind of treat all those. So if we start with that first one, asset-related expenses. So for this one, with the exception of inventory under that cost-incurred basis that we walk through, you're not required to disaggregate costs when they're capitalized to an asset. Instead here, when that asset is later derecognized, you would disaggregate based on the nature at the time it's recognized in the income statement, not the original nature of those capitalized costs. And I know that's a little confusing. So do you want an example?
Yeah. Why don't you go ahead and give us one?
All right. So let's say you capitalize $200,000 of employee compensation when you're developing internal use software. You don't disaggregate that when it's capitalized. Later, when you amortize that software, you present the amortization as either depreciation or intangible amortization, depending on your accounting policy, without tracing back that a portion was originally employee compensation. The nature has changed from employee compensation when incurred to depreciation or amortization when expensed. The FASB's rationale is that capitalization affects the natural classification. So other examples that include cost to obtain or fulfill contracts under ASC 340 fall into this category. Film costs under ASC 926. Those are also ones where there's, when it's capitalized, there's no disaggregation that's required. But when it gets amortized, that's when you then present it based on the nature at that time.
That's helpful. Thanks. Okay, so now liability-related expenses. There's an important exception here. An expense does not need to be disaggregated if all of the following 3 criteria are met. So first, the expense relates to an obligation that will be settled in the future with uncertainty about timing. Second, is based on an estimate of a future expenditure. And third, it's not entirely made up of one required expense category.
Yeah, and to drill this home, examples include like provisions for losses on construction contracts, claims and claim adjustment expenses for insurers. It can also include asset retirement obligations, environmental obligations, maybe certain warranty accruals and loss contingencies. And again, the logic is that disaggregating these would be operationally complex and may not provide actually useful information for the users because they're estimates of uncertain future costs. But not all accrued expenses qualify. So accrued bonuses, accrued paid vacation, pension obligations, those do not meet the criteria and they still need to be disaggregated.
Let's tackle expense reimbursements. The standard distinguishes between reimbursements you receive and reimbursements you pay. So for reimbursements you receive, say from a strategic partner in a funded R&D arrangement, you really have 2 options. So you can separately disclose the reimbursement as its own line item in tabular disclosure, or present the expense categories net of the reimbursement effects. So either way, you disclose how you're presenting it and provide a qualitative description of the expense categories the reimbursement relates to.
And then for reimbursements you pay to other entities, here the treatment is a bit more prescribed. So for those, you must separately disclose the amount as its own line. You can't combine it with other required categories. So if you reimburse another entity for employee compensation, that reimbursement doesn't go in your employee compensation category. It needs to be its own separate line. And then again, you would just describe the nature of these expenses being reimbursed. And this applies, typically like cost sharing or cost reimbursement arrangements, collaborative arrangements, funded R&D arrangements. Those are the types of situations where we see these come up. Maybe some government grants potentially. This is not a regular vendor reimbursement or kind of supplier rebate situation.
Okay. So I guess before we wrap up, let's cover selling expenses and share some practical tips there. Selling expenses is a separate disclosure requirement. Companies disclose the total amount of selling expenses in continuing operations every period and disclose their definition annually or when it changes.
Yeah, and selling expenses is not defined in the standard. We talked about this in episode 1 a bit. So each company, again, has to determine what constitutes a selling expense for them. So your definition should include only items presented as expenses in the income statement. Again, you can't include capitalized costs or revenue reductions in that selling expense definition. But beyond that, companies really do have a lot of latitude here, right? So this might include, depending on your organization, marketing, advertising, maybe client relationship management expenses, customer acquisition costs, any like market research you're doing, business development, fulfillment costs, cost of sales locations. It really kind of just depends on what your company's business model is, on what falls into that selling expense definition.
Yeah, the FASB said management has broad latitude here because what constitutes selling varies significantly across industries. A software company's selling activities look very different from a retailer's. So define it in a way that makes sense for your business, but be transparent and consistent. If you change your definition, disclose it and recast prior periods unless it's impracticable.
All right, so let's share some practical tips for applying these requirements. So first, on standard costing, many manufacturers use this kind of way of thinking about inventory, right? And you have variances that are going to exist between the standard and actual costs. So those variances should be allocated to the underlying cost nature they relate to. Pricing variances on raw materials should go into purchases of inventory. Labor variances, right? Those should go into employee compensation. So your DISE disclosure should reflect actual costs, not just the standard.
Yeah, and so for inventory remeasurements, impairment write-downs, your lower of cost or NRV adjustments, we believe including these in other items is appropriate under either basis. So under cost incurred, you could alternatively present them in the changes in inventory. Really either is acceptable as long as you're consistent.
Yeah, and we hit on this a little bit earlier, but again, companies can use estimates or other methods that do produce the kind of reasonable approximations. And I think this is critical because the reality is like achieving transaction level precision is going to be pretty challenging, especially for very large, decentralized, complex organizations. So if you are going to use estimates or kind of other methods to produce approximations, you just obviously want to be careful about documenting your methodology and the data you're using, any key assumptions you're making, and make sure that that estimate is actually giving you kind of reasonable outcomes based on your facts. And also remember the disclosure requirements they don't apply to immaterial items. So I think that's an important kind of gating factor, is that materiality kind of has to kind of come into play throughout the standard, right? As you're thinking about, how detailed to take a disaggregated standard down to, what needs to be disclosed, et cetera. And again, like any other materiality judgment, it's both quantitative and qualitative in consideration.
Okay, we've covered a lot today. Let's go through a quick recap. Your natural expenses are based on type of economic benefit received. Your functional expenses are based on the purpose in which you incurred them. The 5 categories are purchases of inventory, employee compensation, depreciation, intangible, amortization, and DD&A. For purchases of inventory, it only includes external purchases of tangible items in scope of ASC 330. It excludes business combinations and certain transactions, and your intercompany purchases are eliminated in consolidation. You're going to have to choose between your cost incurred or expense incurred method. Most will choose cost incurred.
Yeah, and then on the employee compensation front, again, that uses the ASC 718 employee definition. So again, you're thinking about that employer-employee relationship under common law. The definition of compensation is also pretty broad here, right? It includes like the wages, the benefits, the stock comp, the payroll taxes. Those one-time termination benefits, though, are reported separately. And just a reminder here that contractors don't qualify as employees, so they would need to be kind of segregated from this employee compensation number. And as we move into depreciation, again, this one aligns with ASC 360, intangible asset amortization with ASC 350. Your finance leases and your internal use software are going to need to follow existing practice on whether you classify those as depreciation or amortization. DISE did not really clarify that as one or the other, so that's still following existing practice that you have as an accounting policy. And then for the last kind of natural expense category, DD&A, again, that's going to apply to those extractive industries only.
Your selling expenses is going to be separate. The total amount is disclosed every period. Your definition of selling expenses is disclosed annually. Companies do have latitude in how they actually define it. So that was a lot.
We got through it all. Yeah, that was a very thorough recap for sure.
So let's talk about episode 3.
All right, final part.
Yep. We're going to shift to implementation. So think your system requirements, your project planning, data gaps, challenges, best practices, interaction, with segment reporting, and then industry considerations.
Yeah, a lot more kind of hands-on as you're navigating maybe first steps, or maybe you're in the middle of implementation. Just some of the best things to take away, I think, will really come out in that last episode. So definitely more real-world examples that we'll be sharing there. But for episode 2 of the series, I think this wraps us up. And we thank everyone again for joining us on Accounting Matters. I'm Adam Olsen.
And I'm Nicole Harger. We'll see you next time for our final episode.
Can't wait.